All right, what's going on, everybody? Even I can trade here on January 2nd, 2023. Just wanted to run through. This is right now about 10:20 a.m. in the morning, and just made our first trade of 2023. Just wanted to kind of talk to you about why I did what I did really quick. So you can see on the screen currently, I've got the market internals pulled up along with the SPX, and I sold a call probably around 10 o'clock, right around 10 o'clock on the dot, and just wanted to kind of talk to you about why I did so. Let me see if I can get this. There we go, all fitting in. So we can see right here, this is the SPX currently. We can see the market is definitely deteriorating off of the open. I'll show a bigger chart in a minute, but I just wanted to show what I saw in the internals. So what I saw, first thing I saw was the put call ratio. The put call ratio was pretty bullish this morning. And we can kind of see why we had a really, the futures were up pretty high this morning. And the put call ratio was pretty skewed to the call side, but it was deteriorating. And the tick was also deteriorating. It was nothing but red ticks around that time. And the volume was definitely skewed towards the bearish side and falling. And the same thing for the 80 line. We saw the 80 line start way high, and then it started to deteriorate. And this is what I saw. I saw all this deterioration in the market. I saw deterioration in the price action right here. I saw a nice red bar. We were pretty deep in the pivot points at that time as well, and the stochastics started to roll over. Let me see if I can show you that. Let me pop open this particular cell here. There we go. So I placed the trade probably around this candle right here, maybe right before 10 o'clock. Seeing all this deterioration, reversion to the mean, gap fill, everything like that. Like I said, we were through our second pivot point to the upside, our second resistance pivot point, and kind of popped through and got rejected off of that. So what I did when I saw that, I said, let me go ahead and see if I can get above everything. And I got a 38.95 call spread off. Seeing all that deterioration in the internals, and saw it down here as well. We were definitely heading back, in towards the mean and everything, and on down to the negative side. And it just felt very bearish based on all of that information. Just this rejection right here, this big red candle and continuation, the gap fill opportunity for the market. Everything was pointing down, that it just didn't want, it wasn't ready to be up here. So I went ahead and took that trade, and looks like it was a pretty good trade. It was only for $15, but we're only looking for 20 on the day anyway. So you could see our cash, we're already in positive territory because we were at 650, and we're already up, $12 to $15 on that particular trade. So, all right, guys. So it is currently 11:12, and I did find a place to go ahead and place my put spread. Went ahead and placed that at 37.75, 37.80, excuse me. And I placed it right on this candle right here. The reason being is I saw this green candle right here look pretty strong at the time. And we bounced off of this support area right here. We got a cross with the stochastics. Got that cross back into the mid area, which I'm looking for. I had a little bit of hesitation because the market the internals are starting to look pretty bearish overall, especially this number right here, the weighted pull. So what this means is the S&P has stocks that are weighted more than others just by their size, and they affect the S&P more than smaller stocks. So this can kind of yank the S&P around a little bit by the nose, and this was kind of red, so it kind of gave me a little bit of pause. But we've got this support coming in. This is a couple months old support that we still haven't broken yet. So this is kind of coming in here. We've also got two pivot points in the way as well. And I was able to get double our expected move at the time. So we went ahead and placed that trade for based on that. So it was probably a little bit early. I do think this is, the market's kind of deteriorating here a little bit, but I don't feel like it's going to accelerate at the time. I don't feel like it's going to accelerate, but we are getting some deterioration. So it was probably a little bit premature. So we'll keep an eye on it. But all right, what's up, everybody? It's 11:54. And I did decide to go ahead and roll that put spread to the next day. I was able to pick up credit on that for 15 cents. I rolled it pretty much where the market is right now, about 23 points away from my former strike, and rolled it down to 37.50, and got myself another 30 points out of the way. I probably could have held out a little bit longer, but just out of an abundance of caution, wanted to go ahead and get that while it was there. The market, keeps deteriorating slowly, keeps making lower lows, and I just wasn't comfortable with it. So just decided to go ahead and take that roll. I think on this candle right here, I do think the market's going to flatten out today. I really don't see it, honestly, getting past this particular zone right here. But I just, out of an abundance of caution, again, you have to be super careful with a baby account like this. So just went ahead and rolled it just to, be super safe. I originally said my red line would be at about 3,800, but it started to threaten 3,800, and I just wanted to catch it. I didn't want to wait too long, because if, we get a lift tomorrow, then I can be out of the trade nice and early and move on to that day's trade and still collect the credit. So if you wait too long to do what you're going to do, it costs more and more and more. So, 23 points away. Let's just go ahead and roll it for now. And plus, my options are limited because I can't put more money into it. I can't expand the strikes. I can't add more contracts to it to get a better roll. So the only option you really have is to roll it early or just close it out. To close it out at that time, I think it would have been like a $70 loss or something like that, just to close it out at that particular time. But like I said, this is just out of an abundance of caution. Things are pointing to the fact that the market could rebound or at least flatten out here. We're definitely in oversold territory. But again, I keep seeing this weighted pull right here that is really influencing me right here. And, it just feels very, very bearish right now. I kind of knew this going in. If you listen to my last video, I kind of thought that a day would turn out like this because we've got, like I said, the FOMC, we've got some big numbers coming up this week. And I kind of think the market wants to get ready and prepared for bad news. I think, the unemployment's coming up, as well as the FOMC minutes. So I just think the market wants to position itself for bad news on that. So I just, like I said, my personal sentiment is kind of bearish right now anyway. So I just don't want to be trying to catch falling knives too much right here. Like I said, I think I got into the trade a little bit early, just trying to get ahead of that theta decay. So I probably should have waited for more confirmation, just because we keep making lower lows. So I should have waited for a higher low before I got into that trade, or just not traded it at all. But that's the way it goes. You just kind of go with what you see and go with what the information that you have at the time. And that's why we have ways to get out of trouble. And that's why we trade spreads in the first place, because, I can't call it at the end of the day, right? It's tough, man. I mean, the market's going to do what it's going to do, and you have your indicators and everything like that. But I mean, it's going to do what it's going to do. So I can't peg it. I can't tell you that, it feels like it's going to go this way, but then it goes that way. And that's why we trade with buffers. So we're just trying to play keep away, man. We're just trying to play dodgeball. So I just, went ahead and rolled it. So there we are. And we'll see how that goes. We'll report in a little bit later. All right. So we're back at the end of the day. Market just closed. And let's take a look at the damage for today. And before I forget, I do want to go over what it looks like to roll, because if you've never rolled before, it can get a little confusing in your account. So don't let me forget to talk about that. I don't know if you remember me earlier talking about this resistance line right here, going back to the October low, but that is a pretty good resistance level, guys. Look at that. A double bounce right off of that resistance level when things are looking very, very shaky today. If you were right here, if I'd have stayed in the trade that I was in, I really would have been sweating. But my hypothesis turned out to be correct. We held twice. Big level right here. Bounced pretty good, actually, off of that level, and ended up retracing quite a bit. And if you look at that pivot point right there, that pivot point was a solid area as well. It turned out to be a solid area. It wasn't earlier, but, look, it's pretty good, right? So we ended up at 688 today, but that's a little wonky, I think, because of this box spread that I tried. If you see right here, this is the other side to the call spread that we did. This is the put side of the call spread to kind of close it out and zero it out and lock in our profits just in case. I did this just to test it out to see if it worked, and it did work, but it made my numbers look kind of crazy because our cash went up here, and we've got a $30 profit for some reason on this particular trade, and it might be inflating the 688 number. I'm not totally sure. I think it is a little bit, but box spreads are typically used as a makeshift loan system by options traders to give themselves a quick kind of loan anyway. So I'm not as surprised by this. I just didn't really think about it in those terms. But that's what box spreads are typically used for, is to kind of allow themselves to give themselves a loan. So I could kind of go in and technically remove this cash if I wanted to, as long as I put it back in, right? But our roll, you can see right here, this is our new trade that we rolled, and this is our old trade that we rolled from. Now, at the time of the roll, I was down $65 on that particular put spread at that time. Now, of course, it would have expired worthless, all that kind of stuff, hindsight 2020 being what it is. But I want you to see what happens with a roll, because what a lot of people do is when they roll, they'll see that they are up $62, $65, or whatever. They're in profit, a good amount of profit on their roll, and they will see this and they will close out this trade saying, hey, well, I made more than I thought I was going to make. I only wanted to make $15, $20, but I made 65. Let me go ahead and close that out. No, bad trader. Don't do that. You'll actually be at a break even. The reason is you still have to compensate for this loss. What you're really doing when you're rolling is you are closing your old trade and opening a new trade. Okay, so a roll isn't anything special. It's just what it's called when you close an old trade and open a new trade at the same time. You're still closing out that old trade and opening up a new one. So you have to treat it as such. And you have to keep track of these numbers because Thinkorswim isn't really going to do it for you. Okay? They're going to show you the profit of the new trade just as it is, as if it was its own trade, and then the loss on the old trade just all by itself. It's not going to combine them. So when I rolled this, I rolled it for a credit of 15 cents. Okay, so that should already tell you, if I roll it for 15 cents, then why am I making $65 on a $15 trade? That should already send some alarm bells to you if you forget this stuff, right? So what I'm actually doing is I'm making up for this $65 that I lost, and then making another $15 on top of that. That is my goal. So even if this was a flat roll, I do not want to close this out for any less than what I lost on the trade that I gave up, that I closed. So I lost $65 here, and I need to gain that $65 here just to be at break even. Now, it gets even worse when it goes to the next day, because this is profit and loss for the day. You can see P&L open says $0 because it's not open anymore. So this is not profit and loss open, right? So if this rolls over to tomorrow, I'm not going to see this negative $65 there, right? So you have to remember, if nothing else, at least what you lost on the closing side of your trade, or what your or just leave this trade alone and let it expire worthless. If nothing else, if you forget, if you've rolled like 5 times and you lost count and lost track of whatever, let the latest roll, just let it expire worthless. Because that's when everything is going to line up for you. If you close it early and you still have money left to make, if you go to your net liquid column right here and you still have a large number right here, or any number or whatever, unless it's like maybe $5 or whatever it is, if you remember what your latest roll was, if you remember that your latest roll was for $15, and this, your net liquid, in other words, how much you have left in the trade, says $15, and you can keep track of all that, then go ahead and close it out. But try to let these expire worthless. That's the best advice that I can give you, to make sure that you get all of your money for your rolls, because I see it all the time that people see this profit number, they say, oh, I'm at profit, let me close it out. Then they look at their account balance and wonder why it's lower. It's lower because you have not made up for the loss that you took on the trade that you closed during the roll. Okay, so just wanted to put that out there. Other than that, still trying to figure out the math behind this box spread stuff, but it closed out like it should close out, so I'm guessing that the math will work itself out tomorrow. I'm just going to go ahead and say that we're up to 686 for the moment. The call that we sold, we made $20 on that. We were at 650, so technically, since this is kind of flat, this roll is kind of flat, I should really be at 670. So I kind of feel like this box spread is messing up my math. But what I do know is that it's positive today, because we made our $20, and we're still well out of the money on our put spread. So that's where we're at. What else should I talk about? One trade that I came across from my guy, Scott Stewart, wonderful channel, wonderful trader. He talked about a trade on the IWM that I thought was very interesting because it's super conservative. And I like my conservative high win percentage trades. I know not everybody likes that type of trading, but I do. And this trade had a 100% win rate last year during this crazy market for him, right? And he trades with real money. They trade with real money over there, right? So not a test. I mean, it could have been a test, but it was a test with real money and real results. So this IWM trade right here, this is basically a strangle. A strangle is nothing but an iron condor without the purchase part, like purchasing the call and purchasing the put. If you just skip that when you're doing an iron condor, you're going to have a strangle. Now, the reason why we normally don't do strangles is because of the capital management piece. Strangles are much more expensive to put on than the equivalent iron condor because the risk is not defined. So it leaves it up to margin requirements in order to tell you how much money that you have to put up for the strangle. But this particular one, since we're using the IWM, and the IWM is, in the hundreds of dollars for an index, the margin requirements are much lower. So you could more easily afford to do this strangle because this strangle is only going to cost you less than $3,000, like $2,600 usually, or something like that. It's going to change a little bit, but the goal on the strangle is not to hit home runs. It's almost to do a bunt, not even to do a base hit, right? So he trades a weekly strangle on the IWM, and he's only looking for 1% gain over the week, like 1%, right? And you collect those 1% every week. You do that 52 times in a row, then you have a 50% gain on the year, right? Maybe even a little bit more, a little bit less. He makes a point to avoid the FOMC meetings because the market goes nuts, right? So he pulls this off during the morning of the FOMC on whatever Wednesday that is. 2:00 rolls around, FOMC blows up the market, wait for the market to come back down, then put the trade back on, right? So I thought this was a very interesting trade to mention. If you did the same trade on the SPX, it would cost you like $80,000, right? Just because the margin is so high, and because of the way the numbers work out, and even worse on the NDX. But the IWM is such that you can do one of these within reason. Now, I also looked it up. If you did an iron condor and the profit margins are so small that the commissions start to affect your trading at that point, because you're getting so close, you're cutting the premium down to the bone on these, right? But the tent is so wide on these IWM trades that you're able to achieve literally a 100% win rate. Now, he did say not every trade was like, smooth sailing, and some were close and cutting it close and all that kind of stuff. But they are easier to manage. So imagine rolling one contract, period, or two contracts, period, whatever, or trying to close out or trying to enter one contract instead of trying to enter two with a spread, trying to get that all lined up. The entries and the management is a lot easier to manage. Your inherent risk management in these is a lot better as well, because it's not, you know, an immediate, you lose your entire investment. Like this loss slopes, right? So it's not like, 1 second you're in profit, the next second you're total loss. This is a slope, so you don't immediately go into loss, which is going to make it easier to roll down, manage, do whatever you have to do, save it by financing it with another side, whatever you got to do. It just makes it easier to manage. So, interesting thought. I don't have enough in the account to do this yet. I still need like 4 or 5 times the amount that I have in here to even attempt this trade. And for my particular taste, probably a little too slow. 50% is a lot on an account. And especially if you have that discipline, but I personally see it more like a savings account type of situation, or if I'm on vacation or something like that where I can't really pay attention to it. Seems like more of a trade for that for me, but wanted to mention it, thought it was super interesting, and there's that. If we go back to the SPX, just to look at a couple of things real quick, and I don't want to make this too long. But if we go back to that chart, let's go to our internals here. You can see how the internals shaped up for the day. One thing that kind of might have given the close away was the deterioration in the VIX, and the increase in the advanced declines. So, well, not really. I mean, this kind of followed the market, so this wouldn't have given you any kind of advanced warning, I don't think. But definitely the VIX trailing off like it did, was a pre-indicator to what the market was going to do. The tick, that really wasn't that helpful as far as that, but definitely the VIX today. Now let's look at our multi-time frames here. And we can see the line that held was this line. This is the monthly chart right here. The line that held was this line right here. So pretty cool. Here's a daily chart showing the same thing. This is that October low of last year. And that support line held. So what that tells me is that the market wants to stay inside this triangle. It wants to stay inside this triangle a little bit longer. Now, everybody and their mama thinks that the market is going to fall, back down here into the early 3000s or whatever. And it certainly could. Certainly could. If it was going to do that, it would probably follow or bounce off of this support area here. So maybe the 3200 area we could see, but that's what we're looking at. So, all right, guys, that's all I've got for today. Let's see how we shake out for tomorrow when all these trades kind of settle out, and let's keep it going. All right, later.